I've been in this business a long time. We had no 10% correction during the year. That is an anomaly. That is not normal. So in 2025, my predictions, you'll have more than one.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. I'm going to apologize up front, David. I did some old-fashioned Christmas caroling with some friends, and the pipes are still a little rough, but it was fun. How was your Christmas?
It was awesome. It was nice and quiet and just chilling at home with Melissa, our dog Risen, and our son Noah. So
you needed some nice and quiet. You had 18 people in your house at Thanksgiving.
Yeah, so, it was actually nice. And this is the first Christmas in years that we've actually been home. We've been traveling, going to see both our families. Yeah, last couple of years we were doing 2 sets of Christmases and renting a car and driving from Orlando up to South Carolina. And anyway, it's just last year I remember we flew home on Christmas night at like midnight. So I'm just, was really thankful to just sit in my recliner, watch a little football that didn't have the outcomes I wanted, and a few old good movies. Yeah. So anyway, it was nice. It was nice and relaxing. How about you? Other than the caroling?
Well, a busier Christmas for us. We did a lot of hosting this time around. Sometimes it varies, but the Christmas Eve, and then a brunch on Christmas Day, and then a dinner on Christmas. I kind of felt like I was working in a restaurant for part of Christmas, just washing dishes and so forth. But a good time was had by all. We'll do our extended family Christmas this weekend as the show is airing, so it's not another round of Christmas. And then I think the season will finally conclude. But so far, so good.
Well, I will tell you, I was kind of excited. Is not one, but 2 different people came up to me at Christmas Eve service at my church that came upon our invitation when I had Pastor Bart on our show last week. Had never been. So we did, I'm always, evangelizing where I can. That's one of my always challenges to myself is, can I evangelize a little bit more? And anyway, it was nice to have 2 different people walk up to me, shake my hand. Hey, I'm here because you invited me on the radio. I've been listening for a while. And so that was just nice.
So they heard this segment. Yep. Of course, Pastor Bart Wilkins, the lead pastor at Flatland Church. Your church was with us for a segment of the show.
I actually got to hear him sing on Christmas Eve, which I've never heard before, by the way. I've been attending his church for over 7 years, and first time I've actually heard him really sing. So,
does he have good pipes?
He does. And his daughter, who works for us, our director of finance, Abby, was singing. Yeah. Shannon, who's producing our show, was singing several of the songs. So, I just, this is where my, I feel inadequate because I have no musical skills, except maybe I can recall tunes pretty well, but that's about it.
Well, what I lack in talent, I try to make up for in enthusiasm in my singing and my dancing, whatever it is. But
I'm pretty good at karaoke if you like the show. If you want to hear the song, not so much.
All right. Well, meanwhile, the news keeps on rolling, keeps on grinding, David. So let's get caught up here. Big Lots will soon start going out of business sales at its remaining locations. David, I understand running a business is tough, and many American businesses fail, but these are major, iconic brands that are going down, and we're talking about 30,000 jobs here.
Yeah, and unfortunately, they since that article came out, I think around December 20th, when I'd sent it to you, they actually officially filed for bankruptcy now, and will go through the process of closing all their locations, and they are going to go through a liquidation, so they're going to sell everything and just basically shut down. And you're right, that's 30,000 people that will now be unemployed, and the hits just keep coming, unfortunately. And the reason for this, people need to understand, is like we've talked about this enthusiasm in the economy, the Small Business Administration, the numbers are through the roof. I've been optimistic since the election because we're going to go into maybe a better business environment, let's just call it, than what we currently are in. But the problem is the damage is done, and the American consumer is tapped out, and they cannot afford to spend. We've talked about Walmart shoppers picking up steam because people were downgrading from like Targets, et cetera. And we've talked about how people are tapped, and so it did not spread out to the lower income retailers like Dollar Tree, Dollar General, and Big Lots. And so now they are taking on the chin because they have the wrong inventories in stock. They can't price them enough, and the wage inflation that's experienced, they can't get people to show up to work to serve the stores anyway for the wages they can offer. So, and of course, on top of that, I didn't give it to you this week for a story, story. We had Starbucks right here in town. We had Amazon's big warehouse out near where I live on the south side. Picketers out there going on strike, and Starbucks people are demanding $30 an hour. I'm like, somebody needs to just take these kids, hey, let's just run you into the library here and let's just do a basic economics class.
Yeah.
Do you understand what you'd have to charge for that cup of coffee? I did the math, and Starbucks, if they paid their average wage $30 an hour, they would have to pay over $11.50 for just a cup of Joe, right? And nobody, they just think, oh, these greedy corporations. That's not how it works, And again, anyway, it's just, it's sad because we're gonna have to go through this to get to what's on the other side, and I expect more job losses in the near future.
Well, speaking of going through it to get to the other side, now the data is finally, you can run, but you can't hide. Eventually, the data is going to catch up with you. And you sent us some charts and graphs regarding cumulative job cuts, this idea of employment contraction. Whatever's happening in the rarefied air of the markets, this is what's happening at the ground level, grassroots level, where people are living and working or trying to work. Tell us about employment contraction.
Well, so we saw the tech companies in particular, and that's what's been leading this market. Again, the Magnificent Sevens back to the forefront, leading away. And the reason their stocks have continued to go higher is they were cutting costs. They've slashed tens of thousands of very high-paying six-figure jobs, and that is continuing. And now we're seeing it across the board. And now this chart you see here that I provided just shows you the cumulative job cuts. Over 1 million jobs have been cut this year. Yet we were told prior to the election, from all the BLS reporting and the surveys from the government, we were adding millions of jobs. And when it turns out, not only did they revise that down by over 800,000 back in August, 640,000 of the ones they haven't revised down yet weren't even real, right? They were estimates. Now they're coming out saying, well, they were just estimates. So sadly, our economy, we're again, there's no reason for them to hide the information anymore. So as I said, if I were on Trump's economic team, which I'm not, I'm open for the call, is they should go ahead and let the pain come, find out where we really are, and then as you institute cost-cutting measures, deregulation, et cetera, you can get some updraft. But there's going to be a lot more pain throughout our economy, and people need to be prepared for it.
Well, now, another thing we're seeing, and you've got a chart showing that as well, is you have employers, they're not getting rid of people, but they're cutting hours.
Significantly.
They're trying to hang in there and keep the people on board until better times come, as you said, break through to the other side. But until we get there, can this strategy work? Is this sustainable?
Well, so what companies have done is, and listen, a lot of companies, including me, have learned the lesson through the pandemic, through the COVID nonsense that went on. And I'm sorry, it's nonsense now, and we realize shutting down was a mistake on the economy. Almost all the measures they gave us were, not factual or based in actual real science, and so they didn't do anything on good. And unfortunately, wage inflation took hold. We threw out all this free stimulus money, and people had just expected more, so the wage inflation caught up. But when you lost somebody, it was so hard. I mean, we had to speed up our hiring process. We used to go through 3 interviews minimum for any employee before we'd hire them. You had to cut that to 2, or you lost the candidate, right? And so there's been a shift, and that is shifting back now. The employment world is shifting back. So companies, rather than let go of somebody, we may not need this person. Well, how hard is it going to be to replace them? They've cut their hours significantly. And that's what this data shows, is the hours have been cut significantly. But ultimately, companies are going to have to let people go to get their numbers in line. And what the chart we have showing right now is showing both in the manufacturing sector and the services sector, what is the likelihood you're going to offer more hours or hire more people in the forward 12 months? And both those charts are heading down significantly. In fact, service industry, which has been keeping the economy afloat, that's one of the biggest downdrafts month over month we've ever seen. So it does not bode well going into the new year.
Finally, David, we've tracked this story as it played out. I just get such a kick out of this. It sounds like something out of a TV show or a movie, a mob show. Father, son plead guilty in $100 million New Jersey deli stock scheme. You've got this standalone store for Omaha long-timers. It kind of reminds me of the old Zestos down on 13th Street outside the ballpark, just this little nondescript standalone shop, sandwich shop, and it was a front for $100 million stock scheme. David, remind us how that happened, and it looks like it's finally playing out here. What's the result?
Yeah. So what happens is you had somebody come up with the idea. It was a broker, I think, in Jersey that came up with the idea. Hey, we'll take your company public. Just so you know, when you go public, it doesn't mean you go on a reputable exchange. So one of the things we never allow clients to purchase here, and sometimes they call wanting to buy these things, is what we refer to as penny stocks. Okay, so that's any publicly traded stock, even on a reputable exchange, that's price is below $5 a share, because there's a threat you could be delisted. So we're not going to play in that arena. We're just not going to do it, but people do. Then there's what we call OTC stock, Chip, over-the-counter stocks. These are the pink sheets, is what we used to call them. These are stocks that they're publicly owned. There's shares out there, but their finances won't allow them to actually trade on a reputable exchange. And people lose their shirts on these every day because there's no market maker. There's no bid and ask, and the spread between what you buy the stock today and could turn around and sell it the same day could be 40%. And so these over-the-counter stocks get pumped and dumped. These run these pump and dump schemes. You can go back and there was a movie early in my career called Boiler Room that this is what they did. All right. And so you need to understand, and it's also the Wall Street movie, Leo DiCaprio brought it to fame, The Wolf of Wall Street, very similar. But this is one of those where they basically took two companies, they took them public with terrible finances and padded each other's earnings, selling stuff to one to the other to make it look like they're doing well, to basically scam people out of about $100 million. And I'm glad that it's finally come to a close. But again, the word here is at the end of the year, do a risk analysis if you've never done one on your portfolio as it stands. Don't go chasing high flyers, walking into what I believe is going to be some challenging times for a new administration because of the debt load and what we're seeing in the employment market. And the last thing you want to be doing is taking excessive risk chasing these things you see on social media or pump and dumps, et cetera. So just be cautious out there.
Up next, price-to-book valuations, European economic growth, Chinese bond yields, new home sales. David Brooks does a deep dive into a variety of economic data. What does it all mean? Stay tuned and find out. You're listening to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, you sent a chart about price-to-book valuations, noting that they're higher now than in the dot-com crash. And I think I should be concerned about this, but first I need to understand, what is a price-to-book valuation?
All right, so companies are valued, right? The market values companies at whatever they think it's worth, right? And if we believe in an efficient market, and there's what's called the efficient frontier, a company's worth whatever it's trading at because that's what the market says it's worth. But one of the measurements we would track is, and we track several, is price to book, which is what is it worth if we just had to liquidate its assets, right? The real estate it holds, the inventory it holds, so the cars, the trucks, whatever it is. So what is it worth, just its assets? Then there's price to sales, there's price to earnings. There's many ways we can track. And the reason we track this is, and again, the market is paying a multiple, typically we're going to pay so many times earnings is the most common way you would find the value of a company. Historically speaking, the S&P 500 trades around 17 times earnings. Right now, it's trading around 28 times earnings, right? So you're having to pay a whole lot higher price for current stocks. However, their actual assets are also, we're trading over 5.5 times book value. Book value is historically around 1 to 2. You'd pay 1 to 2 times its hard assets, right? Just because it's liquidation. You could sell the real estate for what it's worth. So why would you pay 5 times for what it's worth? So this is just a measurement to tell you if stocks are probably in a heightened stance, if you will, overvaluation. And right now, again, you have to go back to the .com. We just took it out. Book to earnings ratio or price to book right now for the S&P 500 is higher. You're paying a higher multiple now than you did during the .com bubble, and we know how that ended. So again, I just, as we go into the year end, want people to take heed and have a word of caution that things almost always have to reset to the mean, right? And the averages work out. Math is math, and so it's a very, very risky environment right now.
Math is math. I understand your statement, but also this must be an exercise in the study of human psychology or something. You're telling me people are out there paying way more than these things are worth on paper. Why?
That is a great point. And to understand that, you have to understand how the money flows, or sometimes I refer to it as the machine works. So when I got in this business, the retail investor was less than 20% of the rake, so to speak, the ones playing every day. It was big institutional clients, pension funds, mutual funds, hedge funds, et cetera, private equity groups. Today, 90% of the money flows in comes from the machine, which is through 401k, passive investments, right? People buy these, just buy index funds, as John Bogle of Vanguard fame always talked about, just buy these passive ETF tickers, and we use them, by the way. A lot of portfolios do, and they just keep buying regardless. They don't look at valuation. They just, this is in the S&P 500, I'm going to buy it, and they dollar cost average, and they're buying it every day. So what happens is you allow these multiples on PE ratios, sales ratios, and book ratios all to expand to just insane numbers, frankly. And again, it doesn't mean it can't go on. I remember the famed speech way back even before I got in this in 1996. Alan Greenspan, who was then Fed chair, we have irrational exuberance, and if you remember, we had 3 more years of double-digit gains before it finally cracked because things got out of whack. And again, I don't know when that's going to happen, but it will happen, sure as I'm sitting here. So the word here is just understand that you should be very cautious, understanding what you're paying for risk assets. It's one thing if you're 32 years old and you're 35 years before you're going to touch these assets. So it's another thing if you're 62 and 2 years or 3 years away from walking into retirement and going to rely on this portfolio to provide steady and income throughout the rest of your life. So just take heed.
Well, David, we live in a global economy, and the financial markets are global in scope. And you sent the team, a couple of items. One was about GDP growth or lack thereof in the European Union, and also the bond yield in China. Why do we need to know about these things?
All right, so the bond yields in China are a scary thing because they are down around 1%. So who's going to buy those bonds? China is trying to push stimulus into their economy, and it's not working. They're north of $2 trillion in the last 4 months. They have stimulated their economy, and it's the real estate market in particular that is severely, severely underwater. So now what we're seeing China do is actually issue debt. Are you ready for this, Chip? In U.S. Treasuries through German exchanges. So they are going and taking their treasuries and creating these packaged security products where people are buying U.S. debt and they're not buying China's debt. So China's yields are falling off the cliff, and basically it's an anomaly we've never seen before. So again, they are trying some unique and desperate moves, and we're seeing all this global economy. It doesn't work when sovereignties don't play fairly against each other. And again, China, we talked about, doesn't let their currency float against everybody else's currency like most of the world does. Now let's flip to the European zone, which is absolutely in recession now. You've seen Germany in recession for a while, and I brought a chart to show you they have pushed wholeheartedly since the great financial recession of 2007, 8, and 9, right? During that period, they ran into, but all the countries printed money. We did in two. TARP was our first big expansion, if you remember that program. But we stuck with capitalism, right? And we clawed our way out through capitalism. Europe went full-fledged into socialism in all of the EU, right? And their economy hasn't gone anywhere since. If you go back and look, I've got a chart we can share that shows the GDP of the Eurozone, the EU, and the U.S. back in 2009. And we were basically running side by side, right? The size of our economies. Well, if you see the chart I'm putting up today, you can see that chart now shows you we've basically doubled them in the last 14 years.
Well, because the Eurozone has just stalled out. It's where it was.
It hasn't gone anywhere.
In 2008, 2009,
and again, you cannot,
ours
explaining,
has continued to grow.
And even my own kids, I have to have this argument. You can't take the pie and because somebody has a bigger slice, take it and just hand it to other people that don't have. You have to grow the pie. We've shown you. We've doubled the size of our pie, right? Europe is still fighting over scraps of the pie, and they're giving it to people that didn't earn it, and therefore it becomes more sluggish. If you overtax and overregulate the people that provide, guess what happens, Chip? They stop providing or they move away. And so we need our legislature here in Nebraska to understand that. I mean, I can't tell how many clients I've talked to this year that are considering moving across the border because we're still so far behind our surrounding states. Make it an economic boom by moving here and your economy will flourish. And there's so much data to prove this. But anyway, here's a very simple, that chart says it all. Capitalism works, socialism doesn't.
Well, and this is the IMF, the International Monetary Fund, providing this data in case somebody's thinking, is that Fox News or something?
No,
that's cooking the books.
They lean to the left themselves, the IMF. Absolutely.
Definitely. All right. David, another one of these strange dichotomies, and maybe you can make sense of it. So you set the team a chart showing new home sales looking bullish, but then I guess the other shoe dropped. You also set a chart around showing that sales of existing homes is going to plummet. How does that happen? Shouldn't they both do? Shouldn't they be in tandem? Shouldn't they be in sync?
Well, okay, so new home sales I'm not bullish on. The amount of inventory coming out is basically almost at record highs. So the amount of inventory for new homes for sales is skyrocketing. So in other words, the big builders, Toll Brothers, Lennar, D.R. Horton, et cetera, they are finishing these homes and nobody is purchasing them, right? So the inventory, that's the chart we're showing right now, is skyrocketing, okay? That is not a good sign. And so if you just go on Zillow or Realtor.com or any of these, Redfin, there's several of these websites that you can just go to, which I do almost weekly, and track data and start to pull up neighborhoods. They are having to cut prices. Some neighborhoods are cutting them over 30%. 30% off what they listed the home for previously, a brand new home. There's some in there's an area just south of Tampa called Lakewood or Longwood Ranch, et cetera. It's near Sarasota, but they had houses for sale for $399 that are now $309. Houses that were sale for $369, they're on their website, Lennar. You can look this up for $289. Yeah. They are fire selling, trying to blow out this inventory to anybody that's willing to take the risk and purchase them. So I would tell you, if they're willing to cut their price that much, is it something you really want to go purchase? And I don't know.
All right, so these aren't sales. This is inventory, and now that makes more sense. Oh, and by the way, it's getting tough to sell an existing home as well.
Yeah, so it's a pretty tough time to be a realtor or a mortgage broker. And I have friends that are both, and we have clients that are both. So I also gave you a chart that shows you basically existing home sales, but it shows you have to go all the way back to 1995. So 29 years, you have to go back almost 30 years to show existing home sales this low. That is an eye-opening chart, right? You saw those numbers drop after the Great Recession for a period, but not even this low, and then skyrocket on. And now, what does that tell you the state of the economy? And housing is a huge piece to our economy because every time a new home is sold, and we showed you they're not being sold, it creates about 2.7 permanent jobs in its local community. So therefore, if that's not happening, are those jobs being created? Well, we showed you the data on the show. No, they're not. Again, so if you're thinking about purchasing a home, there may be a better time coming around the corner. Now, again, real estate, I've owned it forever. I talk about it all the time as a fantastic investment. However, it goes through pockets of going backwards. Every 15 years or so, real estate has to do a reset. We've seen that already in the last year and a half in commercial. We may see it here in the next 18 months in residential as well. So again, be cautious out there with whatever you're doing. And if you're looking to sell your home, make sure you understand, you make sure you know what its real value is. And that's the reason these listings are growing, skyrocketing. People are not, they're in fantasy land what they think their house is worth. Well, I saw 6 months ago it was worth this. So that's not what it's worth today.
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. First question is about retirement income. Help me with some retirement math. My husband and I have $1 million total in our 3 retirement accounts. We would be quite comfortable living on $100,000 per year in retirement. Even if Social Security collapses and goes away, if we get a 10% annual return on our portfolio, we should be in good shape, right? David?
All right. That would be an aggressive assumption.
The 10%?
A 10% return on your portfolio every year. Even if you've averaged that, which a lot of people have over the last decade for sure, the reality is when you're drawing down your portfolio for income, you don't have as much in there to make the gains back. So if you were to go through a bad down year, if you had a 30% drawdown and you took 10% out, how much money do you have at the end of the year?
Ouch.
You'd have about $600,000 left, right? So of $1 million. So you'd be down 40%. Now, if you're going to take 100,000 out the very next year, even if the market has a 20% up year, your 600,000, if it earned 20%, would earn 120. So now you only have 620,000. Again, you can take 100,000 out the following year, you're going to run out of money. And so there's an old rule, and we don't follow it exactly, but it's still a good rule of thumb to at least just give you some parameters of where the math lies, and it's called the 4% rule. If you withdrew 4%. The other thing is if you stay fully invested, if you don't understand risk versus range of returns, right? And we actually have an exercise we can show you on this, but basically a 4% withdrawal rate, if you happen to retire January 1st, 2000, right? And the 90s were good, like we've had these last couple of years, good years, and you walked into retirement and did a 4% withdrawal rate and inflation adjusted it at 3.1%, you would actually run out of money before today. You'd be out of money.
Even at 4%.
Earning, if you just fully invested in the S&P 500 over the last 24 years, you would be out of money today. So you have to understand, because of drawdowns, you have to look at things differently. Your risk adjustments should be different, and you should calculate how it goes. Now, is Social Security going to go away? I don't think so. Is it going to be cut? There's a high probability of that, the way our government is spending money. But we can even model in through income planning, if Social Security was cut by, say, 27%, 33%, the different numbers that are being floated around, that, when you get your letter in the mail, if you don't know, it says it right on there, your Social Security is threatened to be cut by 22% or whatever in 2034. We can model that in for you and show you how to build a portfolio that has the bumpers and guardrails. It's not about the rate of return. It's about the range of returns once you start drawing income, because with less volatility, you'll have more of your capital available each year for that withdrawal rate. And we can actually show you exactly how to model a portfolio, so you don't have to go in there, because this sounds like something Dave Ramsey had said, I just want to take 12% off my portfolio. And CFPs across the country came out and kind of bashed him. What are you even talking about? And again, stuff like Dave Ramsey has no licenses as far as I am aware of. He's never passed a licensing securities or insurance in his life. So anyway, just be careful on that.
So if this question came from a client, you would say, no,
absolutely not.
You cannot be content to just say, well, I'll just be fine with $100,000 per year off that $1 million. No. That's not the way it's going to play out.
But it's realistic to have $100,000 income if you've got $1 million in your portfolio, depending on what age you are and how much other guaranteed income we have. So in other words, if they had $50,000 coming from Social Security, now they only need to draw $50,000 from their portfolio. That's much closer to being realistic. So again, we can model all this out, and it's not just what you need to live on today, though, Chip. We have to inflation adjust it, but we like to front load the spending because of the go-go years, right? The first 5 to 10 years are when you still have the same health ability to do things, mental ability, and financial ability, and then you slow down. That's just reality. I've done this a long time, and I think I always caution people, listen, you're going to retire once, hopefully, right? We've helped thousands of clients retire over my career, and we want to make sure you get it right.
David, you mentioned Social Security, and that's actually the focus of the next question. My parents are in their mid-80s. Mom is in good health and probably will live well into her 90s. Dad is on the verge of hospice care. Mom was a homemaker all her life, so she did not generate Social Security income. When Dad dies, does Mom no longer receive Social Security, or does she get Dad's Social Security?
Okay, these are great questions. So assuming your parents have been married for a long time, based on the way the question was written, your mom is getting a Social Security check, or should be getting spousal benefits off of your dad's Social Security. However, when he passes, she will lose the smaller of those two checks. She will, the survivor keeps the larger check. And for any of those that are late in life marriages, you only actually have to be married 1 year for that to apply. But anybody that's been married, she should be collecting a spousal benefit. And if she's not, you can go apply for it immediately if someone somehow didn't do that. But yes, she will keep your dad's Social Security. She will lose her own if she's collecting the spousal benefit. But if your dad's in hospice care, one of the things you should be looking at if they're in their 80s is if there's any dollars that are in traditional retirement accounts still, and a lot of times there's not at this age, but you still have money in IRAs where he's having to take RMDs, you may consider a Roth conversion, because unfortunately, if your father were to pass away, whether it's this year, next year, et cetera, in the year we lose the spouse, we can still file a joint tax return, and there's some tax advantages that can be utilized here to put your mother in a better position. Again, this gets a little complicated.
The widow's dilemma, getting creamed as a single filer, not seeing that one coming.
And we want to make sure that your mom doesn't then get penalized for Medicare B and D, et cetera. There's a lot of things that people have no clue happen until after the fact, and this is is what pre-planning and proactive planning does.
Well, speaking of Medicare, our next question is about healthcare. I'm a 63-year-old female, single, and I want to retire now, but I won't have access to Medicare until age 65. What can I do about health insurance until I qualify for Medicare?
Okay, so depending if you're 63 or 63 and a half, the answers may differ. So if you were to leave employment, you may be eligible to take COBRA from your group plan for up to 18 months. So that may be the bridge that gets you there at 63 and a half. You may also look into purchasing short-term health insurance. These are plans that are 364 days in length, and there are companies out there that almost auto-renew them, and that may be a way to bridge it, or you can go on the marketplace. And again, depends on what your income level is going to be, but I will tell you at 63, and Chip, you just went through some of this process, right, with what healthcare costs. It's not cheap, so you need to understand you're looking at well over $1,000 a month, depending on the type of coverage that you purchase, and I have no idea the assets that you have, if I could tell you that's the right move, but I can tell you we do not want you to take the risk of an uneventful health event, because it could be $1 million in very quickly. So what we do is we put together plans, show you all the options. We can even bring in our healthcare specialist to show you exactly what it would cost and let you know with the assets that you have what it's going to cover to cost your out-of-pocket expenses if it's a good decision or not to retire. Now, again, don't guess. If you want to retire, have someone show you a plan if you can or not. And as a fiduciary, we're going to tell you yes or no. We're not going to tell you, oh yeah, just go for it. We're going to let you know, no, you need to work till 65. And wouldn't you rather at least know that? And of course, I would tell some people that are only a year or so away from retirement, I want to go now. Well, once we've set the date, it's kind of, it goes by quickly, and you're motivated knowing, hey, it's right around the corner. Your attitude at work is better, typically, et cetera. So we'd be happy to help you do that. That is what our report card is for, to show you if it's possible. And always tell people, we want to show you it's your work-life optional, Chip. You tell us when you're going to retire. We're going to let you know if it's possible or not at that date. Some people like me are probably going to continue to work for a very, very long time. Great question, though.
Up next, David looks back on the highlights and lowlights of 2024 and then peers into his crystal ball and tells us what he sees coming in 2025. You're listening to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, I guess what I'm going to ask you to do now is to give us a mini or a precursor to the annual State of the Market address. That's usually early February, kind of tied to the State of the Union address nationally, where you look at the year that was, you look at the year to come, and I think are we going to be at the Durham this year?
I believe so. So we're going to secure that. I think we've rented the whole Durham Museum out for the event.
It's a neat venue.
It is a neat venue, and for the first time in our history, we're going to invite some of our listening audience to attend this event. So this is normally an event exclusively for our clients. We're going to have limited seats for guests, but we are going to allow, based on how many of our clients, which come in great numbers to these events, so we'll have more details on this here coming up in January. So if that's something you'd like to attend, this is where we kind of go through a preview, if you will, of what happened in the previous year and what the big themes are we think we're going to be paying attention to in the coming year.
But this is a serious deep dive. I mean, you are throwing up 20 or 30 charts and graphs. There's a lot of data. This isn't just kind of
it's not a fluff meeting for sure.
No,
this is not a fluff. This is
hard data and analysis.
Our clients have come to really enjoy this, and then I end up now doing a very short version for those that are not, because we have a lot of clients that are not local, so we do a recorded 20-minute version of that for them as well. But yeah, this is a presentation a lot of people look forward to, where we just talk about big macro themes, things that we're looking out for. We also sometimes are able to introduce new services, introduce some of our new employees. We've got several new advisors since the last time. We've been really expanding and growing, and so a lot of fun stuff coming to announce at this event. So
we'll give you the specifics after the first of the year, folks. But just keep that in mind. That State of the Market address, that'll be in early February. And it's quite a tour de force. What I'm going to ask you to do right now, though, David, is so here we come to the close of the year. And maybe as a beginning first step for you in preparing your ultimate State of the Market address, tell us what strikes you right now. What are the most important takeaways economically and financially from 2024?
Well, I think there are many. obviously the election was a big focus this year, and I think the election outcomes not only here in the U.S. but around the globe.
We did see a phenomenon.
We've seen and again, I always talk about, look, the political pendulum swings to the right too far sometimes and way over to the left too far sometimes. And I think it's definitely shifted back center right around the globe, if you will. And if you listen to the show for any amount of time, you know that's kind of where I land. So I'm happy about those outcomes. But again, whatever the outcomes are, my job is, my responsibility to my clients is to interpret this data and then make decisions that are going to give the best outcomes possible for our clients. And of course, for our radio audience, that's what we try to do, is to help them understand what is happening out there. So a couple of the key takeaways from 2024, a very strange year. I've been in this business a long time. We had no 10% correction during the year. That is an anomaly. That is not normal. So in 2025, my prediction is you'll have more than one. So you'll have a couple of different episodes would be one of the predictions I will make for 2025, where the market goes into correction territory more than one time. So in other words, it will draw down, we'll recover at some point, and then we'll probably draw down again. It doesn't mean we'll recover fully, but I'm just telling you, there'll be from peak to trough more than two 10% corrections, in my humble opinion, in 2025, because you cannot sustain this level of valuation without substantial earnings growth. The other surprise is that the earnings growth did not happen in 2024 that almost all Wall Street analysts called for. So why is the market continuing to price it as if it did happen? And what makes you think that these earnings will be able to grow next year? So those are some of the big takeaways, is that we are in lofty air, paying extreme prices for things. Doesn't mean they can't go up. Again, all I'm doing is interpreting the data as before me. The election surprised even me a bit in that it was a complete Republican sweep. The odds didn't say that would happen if you went back 6 months ago. Of course, if you went back 12 months ago, the odds that Trump would even be the nominee were still in doubt. And I remember going to a conference with a bunch of analysts with hedge funds. I was up in Greenwich, Connecticut, about a year ago, and they laughed when they just said, who's going to be the nominee and who's going to be the president? I said, well, the nominee is going to be Trump and the president's going to be Trump. And they thought I was crazy. It's so funny because most of these guys live on the coast. Some of these guys were from San Francisco, a lot of them from New York City area. And the way they think and process information politically is very different. And again, these are very smart people, my friends. We get a lot of analytical data from them, but they miss out on what middle America, the way people feel, the way they earn their living, et cetera. And I tell them, I said, you should fly out to the middle, and you don't have to come to Omaha, but you should go travel to St. Louis, Minneapolis, Omaha, Des Moines, Wichita. You need to go visit cities and just do a little analysis and understanding the way the economy works. And then, the other not big surprise is the migration. The Great Migration continued in 2024 from deep blue strongholds of political banyans, New York, New Jersey, California, to states that had a much freer economy system and much better tax system. So the benefit factors were Texas, Florida, Tennessee, South Carolina. We've talked about this many times. That continued, and that was one of the things we predicted would continue. So what I did not catch is how bad housing would slow down in 2024. Again, I've been an avid real estate investor for, most of my professional life, and we are seeing drastic shifts in real estate, and that's one of the reasons I'm so cautious going into 2025.
Well, speaking of going into 2025, let's take a minute or two on that we have left. Now, you mentioned the election, and we have had some charts and graphs in recent weeks showing optimism by households, optimism by business owners. Now, you've made it very clear you said two corrections you think are coming, market corrections, and there's going to be some rough sledding before hopefully the Trump administration is able to replicate what it produced in terms of economic growth the first time around. What's the time frame for that? By this time next year, are we going to be enjoying the same kind of Trump economy that we did when he was president before?
So, a little teaser for the state of the market update we'll be giving. I'm going to go through some demographic information, demography, right? So age of people in America, earning power, et cetera. And so very bullish long term. very, very concerned short term, and kind of leave it at that for now. But basically, and we'll go through the why. So what I'm going to be looking at when we do this review a year from now, we're sitting in this studio 1 year from today, Chip. What policies actually got enacted? Did the Doge phenomenon actually meet its criteria?
Department of Government Efficiency.
And what I love is there's an expiration date on that. They basically want to kill that on our 250th anniversary. So that will shut down if they're successful on July 4th, and so basically on our country's 250th anniversary, which would be amazing if we get it. So one of the things, and again, I know we're out of time for this year's show, so I hope you guys have a blessed and happy New Year, is that, listen, we don't know the future, but you need to be working with someone when it comes to your finances that is proactive in watching the data as it unfolds. That's the one thing I can promise our clients. We're constantly analyzing and taking action, proactively managing portfolios to give our clients the outcomes they desire in retirement.
Well, that'll do it for this week. That'll do it for this year, friends. Hey, please visit our events page at retiresmartomaha.com. We're going to have, David, I think it's more than 150 events in the coming calendar year.
Yeah, that's a lot.
And so on the other side of the new year, you'll want to go to our events page. That's retiresmartomaha.com to see everything that we'll be offering. There's no charge and there's no obligation for our events, but you do need to register. You can do that online at the website, retiresmartomaha.com, or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and happy New Year, and may 2025 be a prosperous year for all.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.